Today, we're looking at an analysis report making a really aggressive bull case for MicroStrategy, titled 3 Reasons I'm Loading Up on MicroStrategy Right Now.
Yeah, this one is all about conviction. It jumps right into the action with that dramatic V-shaped recovery on December 26th. You feel the urgency.
You really do, and it builds that case on 3 key pillars. First, there's that technical bear trap reversal right at $154.12.
The line in the sand.
Exactly. Then you have this wild valuation anomaly, a PE ratio of just 7.38.
Which is, incredibly low.
And finally, a strong buy analyst consensus that's targeting $513, which they tie to a future FASB accounting change in 2026.
Right, and those are all powerful points on their own. But as I was reading it, they felt, a little disconnected, like 3 different arguments for 3 different kinds of investors.
And that separation, I think, gets us right to our first high-level point.
It does, strengthening the central narrative by aligning short-term technical signals with long-term fundamental catalysts.
Okay, so let's break that down.
Well, the weakness is that you have these 3 great reasons: the technical timing, the deep value, and the institutional consensus. But they're just presented in a sequence. It reads more like a checklist.
1, 2, 3.
Exactly. And because of that, it doesn't really have a single cohesive thread. It's not clear which of these is the main driver for the loading up right now urgency. Is this a quick momentum trade or a long-term deep value play?
I see. So the reader is kind of left to decide which reason they believe in the most, which might dilute the overall conviction.
That's it precisely. So the suggestion here is to use that regulatory catalyst, the FASB accounting change, as the thread that ties everything else together.
Ah, so that becomes the why.
That becomes the why. It's the reason the short-term technical when actually matters for the long term. That 2026 rule change is what will stabilize MSTR's earnings.
Okay, and for anyone not deep in the weeds on this, why is that FASB change so critical to the story right now?
Because it completely changes the risk profile of the company, on paper. Before, under GAAP rules, they had to book impairment losses on their Bitcoin if the price dropped, but they couldn't mark it back up if it recovered.
Which created massive, unpredictable swings in their reported earnings.
Huge swings. The FASB change lets them report closer to fair value. It makes the company's financials legible to a whole new class of institutional investors who just couldn't touch it before because of that volatility.
So the market is pricing it based on the old volatile reality, but this report can frame it based on a more stable, predictable future.
And that's the opportunity. The volatility is an expiration date, and that's what makes a 7.38 PE so incredibly attractive today.
So the idea is to restructure the argument completely, right? For a concrete example, instead of just listing the reasons, you frame it as a chain of causality. Something like the market's technical shakeout, that's reason 1, gives us this perfect entry point.
Okay.
An entry point to capitalize on this deep PE discount, which is reason 2.
But the real reason we're acting on this now is because we're getting in just ahead of an institutionally driven re-rating cycle in 2026, which is catalyzed by that FASB accounting shift.
And suddenly that $513 price target feels less like a guess and more like an inevitability based on a structural change.
That's the shift. It's no longer just a bet on a bounce. It's an entry point for a fundamental, structured revaluation of the entire company.
That reframing is powerful. And it leads us pretty naturally to the second point, which is about that valuation.
Yes, the valuation.
The report makes a very strong case for the $158 entry price. It highlights that 65% discount from the yearly high, and of course that really compelling PE ratio.
And it does mention the risk, to be fair. It says, if Bitcoin crashes, MSTR will follow. It's not hiding from it.
No, it defines the downside at $154, but I think you felt that the risk and the valuation weren't quite integrated. They felt like 2 separate statements. And that brings us to the second point, providing a deeper context for the valuation anomaly by stress testing the PE ratio against the stated correlation risk.
Okay.
The weakness here is that for a call as aggressive as loading up, just stating the risk isn't quite enough. You have this amazing PE of 7.38, but the analysis sort of treats it like a stable metric you'd see on a blue chip stock.
When we know it's tied to an asset that is anything but stable.
Exactly. So the reader is left thinking, okay, 7.38 is great, but how cheap is it really if Bitcoin drops 30% next week? The analysis doesn't answer that question.
It's about quantifying that margin of safety. You need to show that the valuation is still attractive, even if the known risk actually happens. That's the core of it. The suggestion is to use the PE ratio itself to build that margin of safety directly into the argument. The reader needs a logical, fundamental reason why the downside to $154 is worth the risk, beyond just a line on a chart.
So how do you do that without getting bogged down in, complex financial modeling that might lose the reader?
You don't need a full spreadsheet. You just need the conceptual framework. You can use some simple what-if scenarios as concrete examples.
Like a rhetorical stress test.
Exactly. You could frame it as a question and then answer it. Something like, what PE would MSTR trade at if its earnings were hypothetically cut by 35% because of a big Bitcoin dip?
And then you'd show how that hypothetical PE is still cheap compared to its history.
Yes. Or, even better, you could ask, how does the current PE of 7.38 compare to the PE MSTR actually traded at during the last two major Bitcoin sell-offs?
Oh, that's smart. That gives it real-world context.
It does, because it tells the reader that even in a crisis scenario we've already seen before, the stock is still priced to be a bargain relative to its own historical behavior.
It anchors that 154 support level in a fundamental argument, not just a technical one.
It shows that the 7.38 PE isn't a fluke, it's a calculated risk-adjusted valuation. That's what gives you the real conviction to load up.
Okay, so we've unified the thesis with the FASB catalyst, and we've stress-tested the valuation. That leaves the third pillar, the one that creates all the urgency.
The technical signal.
Yeah, let's drill down on that textbook bear trap reversal. The report focuses almost entirely on that single day, that vertical crash to $154.12, and then the huge V-shaped recovery, that long lower wick on the candle.
The description of it is great. It's dramatic. It paints a picture of institutions rushing in to defend a level.
But that brings us to a third opportunity.
Which is about the credibility of that specific level, right? Why $154?
Precisely. Establishing the technical reversal signal within a multi-period context to increase the credibility of that $154 line in the sand.
Okay.
The weakness is if you rely only on that one day, that one candle, it can feel like a lucky, isolated event. Maybe it was just a reaction to some headline or a cascade of retail stop losses.
It feels a bit random. It can, yeah. Institutional buying, true accumulation, it rarely happens just based on one day's panic. It usually happens when they're defending a level that was already significant. The report needs to show why 154 mattered before December 26th.
So the bear trap was the big battle. But we need to show that 154 was a known fortress long before that battle even started.
That is the perfect analogy. And the suggestion for improvement is to just briefly anchor that December 26th event in some prior context. Show that the bulls were defending a known level, not just reacting impulsively.
And that confidence is key if you're telling someone that this level is their definitive risk management floor.
Absolutely. It transforms the signal from a potential high-volatility fluke into a confirmed retest of institutional conviction.
And what would a concrete example of that look like? Does it need a whole new chart?
Not at all. A sentence or two would do it. For instance, you could just cite how that $154 level lines up with the support established during, say, the Q3 consolidation period.
Or maybe it was the low that held after the last earnings report.
Yes, anything that connects that December 26th low to a previously established floor. It strengthens the whole argument that this level represents true seller exhaustion. It makes the risk-reward feel so much more disciplined.
It really elevates the whole thesis. It ensures that all three reasons, the timing, the value, and the upside, are built on something solid and historically validated, not just coincidence.
I agree. I think the foundation of this analysis is genuinely strong.